Folks, the Fed yesterday came out and basically said we are going to bury this economy. Despite some progress on inflation, we did end up getting that 50 basis point hike. And because of all the 75 basis point hikes we've had this year, you may be a little bit desensitized to how much 50 basis points really is. 50 basis points at this point in time is still very, very aggressive and very, very hostile. In fact, over the last 30 years, the modus operandi of tightening has been 25 basis point hikes, not 50 or 75. 36 of the Fed's hikes over the last 30 years have been just 25 basis points, and only six have been 50 and only 5 have been 75. And get this, 4 of the 75 basis point hikes that we've had happened this year, and 2 of the 50 basis point hikes have been this year as well. In other words, the hiking cycle we saw this year is extremely, extremely aggressive when compared to the historical trend, and the 50 basis point hike we got is like dropping 100,000 activated grenades on the economy after nuking it all year. And market participants right now are kind of snoozing because they don't have much negative data to correlate these rate hikes with actual economic bloodshed. Market participants have consecutively seen massive, massive hikes, but so far the economy has appeared to just have moderately slowed down. So they are going and looking at this 50 basis point hike and thinking, oh, this is nothing, we got this. The problem though is that there is a substantial delay between treatment versus actual cure, and the side effects don't usually show up until you get the actual cure. When you raise rates, the early noticeable effects are not seen on Main Street for about 6 months. The full effects are not seen for 12 months or even 18 months. Now, obviously, we know that markets, on the other hand, are going to react instantaneously, but in terms of Main Street, that is a whole other picture. And Main Street, the way that Main Street reacts is also what drives inflation. So when you're looking at today's economy, you're just simply not seeing the full picture. You got to go back 6 months first, and 6 months ago takes us back to June, when we were in the 100 to 125 basis point range. You go back a year ago, and we were at basically 0. 18 months ago, also 0, right? So that means that at best, the amount of pain on Main Street attributable to the Fed is going to be dated back 6 months ago to the 100 to 125 basis point region. So the majority of the hiking, the majority of the rough monetary policy medicine hasn't been factored in and hasn't hit Main Street yet. And if you do the math, the effects of the hikes are really going to start becoming crystal clear in the beginning to middle half of 2023. So it's like, okay, wait, and this is the bigger picture here. So the Fed sees inflation trending in the right direction and knows there's a delay to their policy results, but they are still deciding to hit inflation hard, expecting the risk of inflation staying elevated to outweigh concerns over tipping us into a recession. And if you watched Jerome Powell's press conference yesterday, he said that the pace at which we raise rates is no longer as important, but rather the question is how long we stay restrictive. So he's saying, hey, wait, now that we're almost done with the monetary policy medicine, now it's just time to wait and see. Wait until the medicine actually starts doing its job. He's admitting here, hey, it hasn't even started doing its job in any meaningful way. That's still coming down the road. And then you have this new dot plot, which shows we are ending the year at the 425 to 450 basis point region. But FOMC participants are unanimously saying that they expect 2023 to end at a higher rate than 2022 is, which is the complete opposite of market expectations. Market expectations are tilted for cutting to begin in the summer and for us to end 2023 the same or lower than 2022 ends. In fact, Fed futures for the December 13th, 2023 meeting suggests just a couple % chance of ending in a range above 500 basis points, yet the majority of FOMC participants expect that to be the case, which means markets are convinced that the Fed is bluffing, which means right now we have a huge disconnect between what the Fed is saying and what markets are expecting. And if that continues, that means the market has a lot more to sell off, on top of everything else that the market's going to have to worry about in terms of an earnings recession, so on and so forth. If we have a massive, massive earnings recession, and you also have the Fed continuously staying in the restrictive region in order to keep their credibility intact, well, that's a problem on top of a problem on top of a problem. In terms of FOMC participant assessment, you end 2023 above 500 basis points, and then you probably get a drop down to the mid to low 400s, and then you drop to somewhere between 350 and 250, and then you get back to the long-term rates at around 250. But the takeaway here is that at the very best, this current policy assessment, if followed, means that the Fed is going to keep rates in restrictive territory until not just year-end 2023, but also year-end 2024 with rates just above 4%. 4%, which is quite aggressive and is why you saw markets not extremely thrilled today. But there's also that dynamic of, wait, how credible is the Fed when they say these things? Are they just saying this and they're going to flip-flop at the next minute like they've done so many times in the past? Well, it depends how big the economic hurricane is. Right now, the median projection at the Fed is that the unemployment rate will increase to 4.6%, which is a 24% increase in unemployment, and they expect that to stay there through 2024. But this would be an incredibly small increase in unemployment relative to the policy. Ryan Sweet, a chief U.S. economist at Oxford, wrote this, quote, "The expected increase in the unemployment rate between this year and next has never happened without the economy falling into a recession. Yet they are projecting real GDP to be positive at around 0.5%. Very cheery estimates if the Fed doesn't pivot. So either two things. The Fed is very wrong on these estimates, or the Fed is planning on pivoting massively in 2023. In order to get a green year on 2023 with all of the recessionary headwinds, you're going to have to pivot like midway through at least. You don't need to look very hard to see the massive number of industries, especially finance related, that are laying off tons and tons of people. As the rate hikes get consistently factored in and as this economic story plays out, all of this is going to snowball. Here's what Bank of America said, quote, "The Fed remains willing to risk a recession in the labor market in order to bring inflation down, and if anything, the December projections suggest that risk has risen, not diminished." So they are saying something here similar to what I said. By going up 50 basis points when inflation is going down, they are indicating that inflation risk is still rising and thus should be of paramount importance. That said, there is some historical data that suggests some good news in terms of when rate hikes themselves end. We may be in restrictive territory for a while, but at least the level at which we're going to climb seems to be going down. The Fed historically likes to keep hiking until the Fed funds rate is at least greater than the year-over-year CPI, which makes sense, and that's what they did in 74, 81, 84, 89, 96, 00, 07, and 18. Every single time, the Fed funds rate was higher than the CPI before they stopped hiking. That's the last 8 hiking cycles. Right now, rates are at the 425 to 450 range, and the CPI came in at 7.1 year-over-year. If the Fed's terminal rate ends up being about 5%, they're saying it's 5.1% on average in terms of the overall participant survey. Well, if it ends up being about 5% and we reach that by March meeting, well, the CPI really doesn't have that much farther to fall, especially considering the CPI is going to be compared year over year to 2022, which was a year of insane inflation, right? So both the Fed and the historical data suggest that we're going to have an end to rate hikes probably by March, maybe a little bit more into the summer. But if you want to pivot, a complete pivot back into cutting rates in 2023, well, there's one thing that you have to watch very closely. Watch for the redefining of the inflation goalpost. Right now they're saying 2%. If all of a sudden they're like, hey, maybe we don't need 2%. Maybe it could be 3, 4, 5, 6%. Then all of a sudden, hey, they're starting to get you ready for this idea that we can pivot sooner. Listen to this from Prospect. One of the most bizarre aspects of the Fed's policy is its relentless commitment to a 2% inflation target. This target, which then Fed Chairman Alan Greenspan basically made up in the early 2000s, has no basis in economic theory. So here you have people coming out and already preparing you with this new narrative that the 2%, that's irrelevant. It's pointless, meaningless. Oh, inflation can be 3 or 4%, hell, even 25%. It's all just arbitrary BS that was made up. Why should we only have inflation at 2%? Maybe because we need some frickin' price stability in our economy? Now, here's when some of the elites come in. The former chief economist of the International Monetary Fund, Oliver Blanchard, recently published a piece in the Financial Times arguing that the inflation target should be at least 3%. Jared Bernstein of Biden's Council of Economic Advisors observes that the Fed confuses the rate of inflation with the trend. Inflation at 4% would be just fine if it was not rising, despite a lot of worry about inflationary expectations feeding on themselves. That is not happening in the current economy where labor has too little bargaining power, not too much. Okay, so here they are already trying to redefine the Fed's goalposts at higher and higher inflation rates, trying to argue that, hey, it doesn't matter. Price stability, that doesn't matter at all. What matters is a strong economy, arguing that the economy is going to do much better if we just sacrifice that price stability goal a little bit. Getting all the way down to 2% will require punishing the real economy and will produce no real benefits. The only reason central bankers have for insisting on that target is, quote, credibility. But credibility with whom and to what end? It's the 2% target that lacks credibility. Wait a second, Charlie. Okay, why can't inflation just be at above 2%? Maybe because 2% is already a scam and a massive ripoff on the American people. Maybe because even with the record low unemployment rate right now, labor is still having a hard time getting wages to outpace inflation, which means everyday working folks are going to get screwed even more if inflation is above 2%. Inflation is a way to erode the American middle class and has been proven to do that decade after decade after decade. Or maybe it's because if you don't have a stable currency, you can lose world reserve status really, really quickly. I mean, there's a huge list of reasons why you need to have a low inflation rate. In fact, I'd argue 2% might be a little bit too high, especially considering how that rate is calculated. And also, there's a very, very convincing argument that if you have a target rate set in the first place, and then you can just move it when it becomes hard to reach that target rate, well, that is a very, very slippery slope. You could just keep going 2%, 3%, 4%, 5%. Oh, it's too hard to get us to 5%. We're going to have to hurt the economy too much. Let's make it at 6%. There's no trust and credibility in having any sort of target rate that the economy can assume you're aiming for if all of a sudden when times get tough, you decide you're going to change the target rate. That's like going on a diet and then the minute you feel hungry, you're like, well, I'm going to go ahead and I'm going to change my target of not eating. I'm going to go ahead and eat like 50 Twinkies and down an Oreo cake. So watch very, very closely for this narrative shift. Right now, based on what we saw yesterday, the Fed is still acting committed to that 2% target. But again, it's very, very easy to say go on a diet before you start actually feeling the hunger. And once the economy starts really, really turning over, all of a sudden, you're going to start seeing a lot of pain. And the Fed is going to have a lot harder time saying that they're committed to that 2% target. And that is when more and more people are going to come out and pressure them to change that goalpost. And we already know what markets think are going to happen. Jerome Powell or whoever he's replaced with, if he decides not to toe the line, well, the minute the hurricane on Main Street starts, they are going to pivot and they're going to pivot massively. Or perhaps they'll just go and change the CPI again to make it more accurate. Hey, maybe 7% is the new 2%. Anyways, folks, that caps off today's video. Make sure to hit that ravishing like button and subscribe, and we will see you in the next one. Also, yes, while the stock market was tanking today, hey, if you want to get up to 20 free stocks, that also probably went down in value, but you want to get 20 free stocks while trying out an excellent trading platform and broker, I'll also put a link to Moomoo down below. Have a good one, folks, and I will see you in the next video.